Good evening, everyone. Time for this week's silver update. Gonna have to eat a little crow on this one because my big price conspiracy turned out to be nothing but Easter weekend or Easter holiday, which I wasn't aware of how the markets acted, but actually is a good thing because it gives me an opportunity to examine silver pricing, and I'm probably going to be ending up asking more questions than answering them, so that's going to be a good thing because maybe some of you know more than I do about it. But anyway, so let's jump right in. First, I wanted to show you the weekly chart. As Jimmy Rogers said, we're going parabolic. Well, that's true, maybe. I don't really see the curve. I want to see something up in here way, way higher to call it a parabolic, but maybe it is, maybe it isn't. It's one of those things, it's kind of like you can't really say you've gotten there until you've been there. Until it happens, it's all hindsight. So parabolic could mean hitting 100 and falling back to 70. We just don't know. So while it's absolutely true that anything that goes truly parabolic will crash, that doesn't tell you what price that parabolic top will be. And you can see these could have been called parabolic. This one here actually has a better curve than what we're on right now. And so does this. I don't see much of a curve here. So what's the definition of parabolic? Well, pretty much it means that you're talking about infinite price in zero time. So price goes higher and higher in a shorter time frame, and ultimately you reach the point where you're going up to an infinite price in no time. Does that ever happen? No, but that's, as you're approaching that, that's what you get. So very hard thing to call, and I'm not ready to call this a parabolic top. So I want to jump to the topic that we kind of touched upon yesterday. An interesting article came out on Zero Hedge today about this issue, and Tyler posted it saying, holiday, no holiday, doesn't matter, silver's still up by $1. And he's got a chart here of SILV, and that's 47.25. So a completely different price than the close we have here of 46.57. So that kind of jumps out at you to start with. But before I dig really deep into this, I did want to take a look at our option. Haven't talked about it in the last few days, but I still remember our option, our big 100,000 contract outlying position on the July 25 put. Now we're down to 9 cents bid, 11 cents ask. Now what's interesting about that is I believe we are at a higher price now, significantly higher price than when that purchase was made. I think it was around 8 cents, 7, 8 cents. And people would ask, well, how can that be? Well, option prices are based upon a volatility index. So the volatility of the underlying market determines these prices. So the best example I can give is one from Market Wizards. It was an interview, I don't remember who it was with. It was with one of the traders. I believe it was an option trader. It might have been Gary Beifelt, but anyway, he was trading options on the day of the 1987 stock market crash. And one thing that he pointed out was that while the market was crashing, I think the stock market dropped from about 2,700 to about 1,800. It lost about 30-40%. And while it was down a few hundreds of points, and today that would be relatively almost maybe thousands of points, the put options on the S&P 500, the premiums on those puts and the premiums on the calls were actually expanding. So even though the market was down 300 points, the price of the calls had gone up. Now you would ask yourself, why would that be? Why, if the market's down 300 points, would the price of calls be up? Well, because option prices are based on volatility. And when you have a market that's moving in one direction by hundreds of points, What that tells you is that it could also reverse and move the other way by twice as much. It's all volatility. So that's your basic explanation. I encourage you to read Market Wizards and dig that out if you can, but that's your explanation of why these prices are actually higher while the price of silver is higher than when the puts were cheaper than this. So it doesn't make a lot of sense, but it's all based on volatility, and as silver is approaching parabolic or craziness, as it begins to fluctuate violently up and down, up and down, up and down, these premiums expand on options. So I expect these to decay and go down to zero, but as we move violently, they may pump up. That's what options do, is they pump. So that's an explanation of that. I hope that is sufficient. So let's jump back to the silver price, and I wanted to examine a couple of things here. Again, we had the Zero Hedge article talking about how silver is above 47, but we need to figure out where that's coming from. Well, I did a little bit of research, and maybe some of you know more than I do. Let's go to the Silver Institute to start with. Now, the Silver Institute tells us silver is a commodity that's traded 24 hours a day in the world market centers: London, Zurich, New York, Chicago, and Hong Kong. Now, right there, that ought to give you pause. Isn't that interesting? I don't see any Asian countries except for Hong Kong, which was a British protectorate, now is given over to the Chinese. But other than that, you've got Britain, Switzerland, America, and Britain. So Britain twice and Switzerland once. There's no Arab countries in here. There's no South American countries in here. There's no other European countries except for Switzerland. There's no Euro countries. Both of these countries, London and Switzerland, are independent of the euro. So isn't that interesting? So that gives you pause right away. This is not a world market. This is what I would call an Anglo-American market. So let's read a little bit further. The London market started trading in the 17th century, and it, like other major markets, provides a vehicle for those who wish to trade in physical silver on a spot basis or on a forward basis for hedging purposes. The London market has a fix, which offers the best chance to buy or sell silver at a single price. The fix begins at 12:15 p.m. and is a balancing exercise. The price is fixed at the point at which all members of the fixing can balance their own, plus clients buying and selling orders. Although London remains the true center of the physical silver trade for most of the world, the most significant paper contracts trading market for silver in the United States is COMEX division in the New York Mercantile Exchange. Spot prices for silver are determined by levels prevailing at the COMEX, although there is no equivalent to the London fix. Handy and Harman, a precious metals company, also publishes a price at noon each working day. Primary factor affecting the price of silver is the available supply versus fabrication demand. In recent years, fabrication demand has greatly outpaced mine production, forcing market participants to draw down existing stocks to meet demand. As these available sources continue to decline, silver's fundamentals continue to strengthen. However, since silver is a tangible asset and is recognized as a store of value, its price can also be affected by changes in things such as inflation, real or perceived, changing values of paper currencies, and fluctuations in deficits and interest rates, to name a few. To read about the evolution of the silver market from 1950 through the present, click here. To view silver price data tables from other sources, please select one of the links below. Now, what's interesting about this is, let's jump over to Kitco, and we get a silver fix at Kitco of 46.61 by 46.63, very similar to the net daily price we saw. But if we jump over to the bullion desk, we see this strange number. Silver is 47.72 bid and 47.78 ask. Price London 22.59. That would be 11 o'clock kind of weird. So let's dig a little bit further here, and I wanted to look at this Handy Harman thing. This is something that cites Handy Harman. Gold PM fixing and EIB pricing will be posted by approximately 11 a.m. Handy and Harman's silver base price will be posted approximately 1 p.m. Prices last updated April 21st, 2011, 12:15 p.m. So this is their in the middle of the day fix. And that's silver base, and then we've got this interesting one here, silver fab. Notice that the price of silver fab is $10 higher than the price of silver base. So that's almost 20% higher. Now look at gold. Gold base is 1507, gold fab is 1620. It's about $120. That's maybe 8%. So the difference between the silver base and the silver fab is more than twice as much percentage-wise. Another strange one. Don't know the answer. You'll have to investigate for yourself. The last one I want to look at is how the metal prices are set. Precious metal market prices are set daily. The London Gold Fix, or Gold Fix, is the procedure by which the price of gold is set on the London market by the 5 members of the London Gold Pool. It is designed to fix a price for settling contracts between members of the London bullion market, but informally the Gold Fix provides a recognized rate that is used as a benchmark for pricing the majority of gold products and derivatives throughout the world's markets. The gold fixing is conducted twice a day by telephone at 10:30 GMT and 1500 GMT. The first fixing took place the 12th September 1919 among the 5 principal gold bullion traders and refiners of the day: N.M. Rothschild and Sons, Mocatta and Goldsmith, Pixley and Abel, Samuel Montague and Company, and Sharp Wilkins. The gold price then was £4, blah, 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 blah. On 21st of January 1980, the gold fixing reached the price of $850, a figure not overtaken until the 3rd of January 2008, when the record of $865, troy ounce, etc., etc. However, when indexed for inflation, the 1980 high would equate to a price of $2,398.21 in 2007 dollars. Thus, the 1980 record still holds in real terms. The fixing historically took place daily at the city offices of N.M. Rothschild and Sons. So all those rumors that you've heard about where it says, yes, Rothschild said the price of gold today is this, well, they're true. Rothschild tells you what the price of gold is. In April 2004, N.M. Rothschild and Sons announced that it planned to withdraw from gold trading and from the London gold fixing. Barclays Bank took its place from 7th of June 2004, and the chairmanship of the meeting, formerly held permanently by Rothschilds, now rotates annually. A tradition of London gold fixing was that participants could raise a small Union flag on their desk to pause proceedings. Under the telephone fixing systems, participants can register a pause by saying the word flag, and the chair ends the meeting with the phrase, "There are no flags and we're fixed." As part of this change, it is intended that a web-based commentary of the fixing will be introduced later this year. The fixing said in a statement, the current 5 participants in the fixing, who must be members of the London Bullion Marketing Association, are Scotia Mocatta, Barclays, Deutsche Bank, HSBC, and Societe Generale. Replaced Johnson Matthey. So, it talks about palladium. Now let's look at silver. Handy and Harman has operated as dealers in silver and gold bullion bars and coins since its founding in 1876. On the basis of their experience in precious metals, Handy and Harman began in 1892 to issue a daily silver price as a service for American silver producers. This price, based initially on conversion of the London price to American terms, rapidly became the basis for virtually all silver transactions throughout North America. Handy and Harman's daily silver price quotation has long since become independent of London. Today it represents simply the lowest price at which on any given day Handy and Harman can buy silver for its own needs, and this price is accepted as a guide for silver transactions worldwide. So, all of that absolutely as clear as mud. So what is the price of silver? You tell me, because I don't know. So I don't know what this 47.70 price is, and I don't know what this closing price is of 46.52. If any of you do know, I would welcome you to chime in the comments and help me understand this, because the further I dig in this down this rabbit hole, it just keeps going deeper and deeper. So hopefully you can add to my knowledge on this, and we'll talk to you next time.